All right, we are just over 1 hour into trading session here in the U.S. It is a brutal, ugly day. Nasdaq down, Nasdaq 100 down over 2%. Abigail Doolittle is here with some of the movers. Abigail, walk us through the price action.
Yeah, really brutal selling action, as you're mentioning, Alex. We have the S&P 500 down 1.7%, the Nasdaq down 2.3%. This after the Nasdaq fell more than 4% last week. Its worst week since March of 2021. So the selling of last week continuing. Small cap also down sharply, down 1.6%, and the transports down 1.9%. The point is, there is nowhere to hide. The cyclical rotation into cyclicals and values that we saw last week out of tech is now moving into all parts of the market. In fact, if we go into the Bloomberg terminal and take a look at the IMAP, even the banks, last week we had the energy and banks up sharply, up about 7% as folks moved out of tech and into those cyclical sectors. Today, you can see all 11 sectors are down in the S&P 500. In fact, the top sectors are the true defensive sectors, your utilities, your healthcare, your staples. Those, of course, are high dividend yielding sectors. So when rates go higher, in theory, those dividends should be less attractive, but that's not the case because there is some sort of sense of risk off right now. Not surprisingly, on bottom, it's your communication services, your tech, and your consumer discretionary. Think Apple, Microsoft, Google, Twitter, along with Amazon. Those are the big decliners right now, down more than 2.3%. The reason, of course, has to do everything with yields backing up in a massive way. Over the last week, you have that 10-year yield up recently, just touching 180. Take a look at the 30-year, or the 10-year real yield, which factors in inflation, up an extraordinary 30 basis points. So folks are really afraid that rates are rising. And the bigger fear, perhaps at this point, Guy, it has to do not just with the idea that rates are rising, but that rates will keep rising, because if the Fed happens to tighten, we could have something similar to what happened in 2014, 15, and 16 when the balance sheet flattened out. We see this massive trajectory up, an $8.8 trillion balance sheet. It's going up, up, up. The Fed is indicating that maybe that's going to change. So if we do go flatter, what will that mean for risk assets? Basically, a brutal repricing of risk on this Monday, Guy.